CPI.
Yes, we are awaiting the May CPI, and 1% on the headline number, up 1%. That's definitely hotter than the 0.75% we were looking for. The high water mark there was up 1.2 in March, so we're close. And that 1.2 was a 17-year high going back to 2005. Strip out the all-important food and energy, it's still hotter than expectations, up 0.6%. It equals our look in last month. And to put a face on it, the high water mark here was all the way back in April of last year, up 0.9. That was a 4-decade high. But remember, both these are hotter than expected. Year over year, these are the Moneyball numbers. Year over year headline, 8.6. 8.6, a new cycle high, usurping March, which was 8.5. That was the highest since 1981. Now, 8.6 continues to be the highest since 81 because the comp there is 8.9 to 11.8%. And if we look at year over year core, also hotter than expectations, up 6%, following 6.2%. High water mark there, 6.5, and that was in March, and that was the highest since 1982. But remember, even at 6%, coming down from the high water mark of 6.5, that standalone is still the highest since 1982. So these are super stubborn numbers. And our panel, our esteemed panel, has lots of brain power there, and they go in lots of categories, Joe, as to why inflation's here, the all of the above mentioned. I will say that out of all the above, energy, energy, energy. And you know, there's so many comments here about, oh, the administration can only do so much. You know what? We all said that about the Fed. And then there's this thing called forward guidance. So the Fed gets the market to do things long before it takes action by telling them what's in their head, what lies down the road. What was the forward guidance with this administration on energy? We know the answer. Maybe they can't get things to happen faster, but by giving positive forward guidance, by not closing pipelines, by not talking pre-election about how much they don't like fossil fuel, maybe things would have turned out a bit different. Joe, back to you.
We're going to get right to our panel, but I don't think we've talked to Mike yet. I know I'm taking a risk going from Santelli to Santoli, even for me to get it right. But, Mike, the reaction in the market has been swift, stock market.
Well, you nailed it on the name. Yeah, it has. Now, look, as I said earlier, we were bracing for something that had the potential to be an unfriendly number, and we got it. Just for context, you know, the S&P 500, we were about 100% below yesterday's close, was the closing low. It seems like the market wants to test that range. I guess you'd have to say the peak inflation number, it remains plausible, the peak inflation notion, but maybe not persuasive. It's very difficult. And if you think back, May 2022 was when the math was supposed to start working in your favor on the annual number, because May 2021 was actually kind of a hot CPI. So that clearly is not the case. And it basically just means, you know, the Fed sees zero opening to lighten up on its rhetoric and on its plans for half-point increases in the next few months.
All right, go back to you where we started, Jason, and then I want to ask you a theoretical question, but just comment on what you just heard.
Yeah, look, I mean, you look at the monthly number, that's what I'd look at, not the 12 months. I'd look at the core, because there's a lot of volatility and other stuff. That monthly number was an 8% annual rate for core CPI. You can point to some special factors there. Car prices were up again in May. Some of that is supply chains out of China, out of Ukraine. Airfares were up a lot. Some of that is people resuming their travel. But even take all those special factors out, the underlying inflation rate here is quite high, and it's potentially rising. Now, I think the good news is the Fed was behind the curve last year. I think they're there now. They're going to do 50 basis points at the next two meetings. They're not going to let up in September. It's going to take them a while to tackle this, but I think their heads really are in the right place right now, and this number will keep it there.
I thought, Jason, that when I watch the stock market on certain days, I think it's worried about the terminal rate. I don't know how many 50s we do. Do you expect it to, are we undershooting or overshooting for what we think the Fed finally stops? And then the reason I'm asking you that is, if the Fed stopped raising rates, can inflation alone cause a recession? Because I always think that inflation causes the Fed to shut down business activity with higher interest rates, and Aka Volcker. But if they didn't raise too much, can inflation itself cause consumers just to say, no mas, I'm not going to spend anymore. I can't afford it, so I'm not going to, and everything shuts down. Have we seen that historically?
On your second, for the most part, no, because when prices are rising faster, wages are rising faster, and so people can afford those higher prices. Right now, wages have been behind prices, but at some point, probably, I hope, they'll catch up. On your first question, I think the Fed's raising rates at a decent clip.
What's
I have
the
no
terminal
complaint
rate?
about that. Right, but that's where my complaint is. I think they need to be clearer. My modal expectation is 4% Fed funds rate at the end of 2023. I think they're going to need to do that to deal with this inflation.
Sound very high.
I don't think the market's ready for. I don't think the market. Sorry, at least 4. I don't think the market's ready for it though. They've not priced that in.
Okay, 4. God, at 4, we would have killed for 4 in many periods of the past. They would have been dropping in half to get to 4. It seems like. Where we go, Mona? Or Strain? I guess we should do Strain. Are you going to argue with? I'll let you talk if you're going to argue with Jason.
I'd love to argue with Jason. I think that this is a bad headline number. Inflation is a real problem. If you kind of look under the hood, you see much less of a problem in underlying inflation. The two big things that I've been worried about are shelter inflation and services less energy inflation. Those both look a lot better than the headline look. They look better than the headline core look as well. And that's the real question. The real question is, are we in for a period where we see wages pushing up prices and then prices pushing up wages and then wages pushing up prices? Or are we in for a period where, we have high gas prices, we have an economy where the goods services tilt is starting to normalize, but the Fed can get it under control? This tells me that we're not in for 5 years of misery, that the Fed will be able to get it under control.
Why is that? I don't understand.
Because this tells me that inflation is not accelerating kind of throughout the economy. Again, durable goods inflation has been declining. Shelter inflation has been rising. Services inflation has been rising, but we didn't see a big acceleration in shelter inflation last month. We didn't see a big acceleration in services less energy last month. And so if things are kind of plateauing along those dimensions, then I would expect that higher interest rates will be able to cool off demand, and the kind of wage price spiral that we're all concerned about seems less likely.
Okay, we have time now, Mona, although I'm dying to get to Kathy Bostancic, just so I can say Kathy B. And I'm going to start. That is going to stick, I think, Kathy. But Mona, what do you think?
Yeah, we're kind of in the camp where Michael's falling out on this. I think generally, while headline inflation will continue to cause some concern, it's hard to handicap how the war in Russia will play out. We're seeing China come back online. All of those factors will lead to higher demand for energy, higher food prices potentially. But if you look at the core inflation, services and shelter and rent are about a third of CPI. And what we're seeing in mortgage prices, moving higher, that is putting some downward pressure on housing. It takes a little bit of time for that to play out into CPI, but over time, that should be a supportive factor for lower core CPI. Also, what we're seeing in terms of some of the headlines around the tech layoffs, for example, over time, that will play into lower wages as well. And so we think generally some of the components of core CPI should trend better. Keep in mind the Fed's preferred metric is core PCE. Raising rates can't really impact WTI or energy and food prices all that much. It's really their focus should be on bringing down the core, and hopefully over time that's a trend we'll see.